In this video, I'm going to reveal my all-in bet in the stock market. Over 95% of my portfolio is exposed to one specific event that has a very high likelihood of happening over the next 6 months. This is what I'm going to discuss, and it's mainly a continuation to my video, which is called Why the Stock Market Will Likely Crash in 6 months. I talked about the rotation from the big seven into the 493 stocks and the remaining stocks, and that's what I'm going to focus on here. I'm going to give you some ideas, give you some stocks that I own, and tell you why I'm doing this. And I believe this is an amazing opportunity in the market, especially if you missed the rally on the big seven. This is an amazing opportunity. Okay, now if you look at the Magnificent Seven outperformers, it has been absolutely insane. Magnificent Seven, they're up 48% year to date. S&P 493 is up 7.5% only, and Russell hasn't even made a new high. I mean, it's absolutely insane. And if I look at the general sentiment in the market, I mean, people on YouTube, people on Twitter, people believe that this is mainly due to two reasons. The first reason is AI. The big sevens, they have exposure to AI, and AI is the future. Some companies are starting to make some kind of revenues from AI. No profits yet, but revenues. So that means that because AI is the future, the big seven, they have exposure to it. So that means this is why they're going up, and they deserve to go up 48% year to date. The second reason is about the whole thing with quality investing. That because those companies are quality companies, and because they're growing revenues or earnings much faster than the other companies, this is why they deserve to be up 48%. And the truth is, those two reasons are valid, and I believe they do exist, and they do make some sense. But I don't believe those two reasons justify the massive outperformers from the big seven to the 493 stocks or the Russell 2000. I think there's another reason, and that's what I'm going to share in this video. Now, if you look at this specific tweet, and it's pretty amazing stuff, that the 10 largest stocks of the S&P 500 accounted 77% of the total gains. Insane for the first half of the year. This is the second highest in history. What was the highest in history? 2007. That's very interesting. What did we have in 2007? We had a peak in interest rates. Interest rates peaked, and then we had this happen. What do we have right now? We have a peak in interest rates, and interest rates are about to start coming down maybe this year in a few months. So we both had a peak in interest rate. Now, that's telling me that investors are getting out of the 493 stocks because they have bad balance sheets. They have a lot of debt without stocks. Russell 2000, they're not international companies. They have a lot of debt. So they're getting out of a lot of debt companies. They're hiding in the good names. They're hiding in the big seven because they have good balance sheets, because they're international corporations. They make money from all over, all outside the United States. And in the United States, they make money everywhere in many different currencies. And they have amazing balance sheets. And I believe investors are hiding in them, not just because they're amazing companies, but just because they're better than the other companies in this specific environment. And this is when they started massively outperforming, whenever interest rates started to go up, especially in 2023. Now, if this is what caused them to go up, what do you believe will happen when interest rates come down? Which is my thesis on the rotation. I believe as interest rates come down, the money is going to start coming out of the Magnificent Seven into the Dow stocks, into the 493 stocks, into the Russell 2000, into the dividend stocks, into all the stocks that haven't been doing well outside the Big Ten. Those are the stocks that should be playing out amazingly well. And it's starting to happen. I'm not claiming victory because I've seen it happen many times. But this is what it looks like. This was on Thursday, and this is when I'm recording this. We had a much lower CPI print, which means the Fed will lower rates. What happened? Money came out of the Big Ten or the Big Seven, and it started flowing into the Dow stocks, into some of the banks, into the 493 stocks, McDonalds, Comcast, even the REITs. REITs went up amazingly well, VC properties and realty income. And this is what's happening. As soon as we had the lower CPI print, this is what happened. And this is what I believe the trend will be over the next 6 months. Now, I could be wrong, and maybe I'm a little bit early, but I've been talking about this for a while. Sometimes we have such days where NVIDIA and the big seven go down and everything else goes up, and then the next day NVIDIA goes up and we're off to the races, and we're going to go to all-time high and all these things. So it means it's possible. But this is my thesis. And the CPI print and what happened to it reaffirmed and gave me more confidence that I could potentially be right on this reason. And this has caused the two bubbles, I believe, in the market, which are the AI bubble and the quality investing bubble, With AI bubble, yes, AI is the future, but again, maybe those stocks aren't going up just because of AI, but just because investors are hiding in them. And as interest rates come down, they might have to speculate on other stuff. Maybe on stocks that have some kind of debt that could maybe MPW, for example. Every time interest rates come down, or I should say, expectations of lower interest rates, MPW goes up, Lumen Technology goes up, all the trash companies with a lot of debt, they all go up. And that's telling me something. And it's very, very important. The REITs go up, a lot of that stuff. So that's what caused people to believe that AI is the future. The second one is the quality investing bubble. And yes, those are amazing quality companies. But again, maybe those companies didn't only get a multiple expansion because they're quality companies, but because they're just better than the other ones in a high interest rates environment. And when this environment changes, then quality investing is going to change. And those multiples are going to come back to earth. And this is a trend that I've been seeing. I've been seeing every single pretty much new account on Twitter, like new people on FinTwit, on YouTube and stuff. Everyone is a quality investor. Like I'm not seeing any value investors. I'm not seeing anyone talking about Buffett and Benjamin Graham. It's all Terry Smith's quality investing. Terry Smith's quality investing. That's telling me something. I could be wrong, but that's just my opinion. Now, in order for what I believe, for example, stocks that will do amazingly well are stocks like McDonald's. And again, you're gonna laugh at me because I put it on Twitter and I got all kind of crazy arguments. But McDonald's is one. This stock is down 14% year to date. Okay, and it's of course it's out of favor because it's a dividend stock, recession-resistant company. It doesn't have much exciting stuff, but of course it's down 14%. Now, if you look at McDonald's, for example, this is my first idea, McDonald's. If you look at it, it has been declining in revenue until 2020. And now it's starting to increase in revenues again. Now, why was the company declining in revenues? Because they've been getting out of the company-owned stores more into franchises. Franchises is lower revenues but much higher margins. So this is why they were declining in revenues, because they were making a change in the business model. And they went from 80% franchise to 95% today. So they already did the hard work. Now the company is starting to finally increase in revenues, and margins are at all-time high around 33%. So they have now massive revenue growth. They have an increase in margins from 18% to 33%. But what is the stock doing? It's going down. It's trading at 20 times earnings. It lowers than the mean of 23 times. It traded as high as 35 times. But now the company is finally starting to grow in revenues. It finally has a high margin stuff, 34%. Microsoft has 36%. And the stock is going down and it's trading at the lower end of the range where it has historically bottomed. But then I put the stock on Twitter and people tell me Ozempic. I'm like, really? If this is why McDonald's is going down, I'm so happy. I mean, I hope this is the reason, because it's massively overblown. And whenever a stock goes down, people always find a reason not to buy it. Oh, it's because Ozempic, dying company, low dividend, people are eating healthy right now. But this has been the thing over the last 10 years. Yes, maybe Ozempic is not going to cause people to go as often. But if someone used to eat junk food and they take Ozempic, it's not going to take the habit away from them. They have this habit. It's not going to take the habit away. It's going to help them lose weight, but the habit is not going anywhere. So maybe you have less store traffic. Yes, that's possible. But it doesn't mean that McDonald's deserves to go down and it's a dying company. At 20 times earnings, I love it. I love McDonald's over here. And I believe this is a stock that's going to be a massive beneficiary of the rotation. And as I said, it's down 14%. The only times it went down more than that were in the dot-com bubble, where it went down 15, 22, 39%. And after that, even in 2008, if you believe we're going to have a recession and a market crash, in 2009, McDonald's was up 0.4%. So the stock even did well, amazingly well, in a recession. So even if you believe we're going to have a recession or market crash, McDonald's is an amazing stock to buy. The second one, which I said I own, was Pepsi stock. Pepsi stock, again, this is another one that's down, and people are saying they can't keep raising prices forever. This is what they say every single time. It's insane. They say they cannot keep raising prices forever. Well, what did Pepsi put up this quarter? 10% EPS growth. Well, they could still raise prices apparently, and they're going to keep doing it. But this always, again, whenever a stock goes down, people find all kind of reasons not to buy it. Whenever it goes up, they say, oh, we should have bought some. It was obvious at 19 times earnings for Pepsi or 20 times earnings for McDonald's. This is what happens. The best time to buy is when it's not easy to buy. Whenever everyone is telling you shouldn't buy it, whenever you can't find any reasons to be buying it, this is the time to be buying that stuff. And Pepsi did put up 10% earnings per share growth. amazingly well. And they still have the guidance of at least 8% EPS per share. So you're getting an 8% EPS per share. You're getting a very good dividend of 3%. This is like an 11% annual return, 11.5%. And you're getting Pepsi at 19 times earnings. It's insane. 19 times earnings for a company like Pepsi with massive pricing power. The mean was 22 times. It traded as high as 27 times, as low as 17 times, and that was in March 2020, or I think it was in 2018 actually. And now it's trading at 19.7 times, and people aren't taking it because, again, they're so blinded by the Big Seven, how amazing they're doing, and all these kind of things. But I believe this is coming to an end. And it's offering an amazing buying opportunity on the dividend stocks, on REITs. Yeah, I told you I own Pepsi, I own Cheniere Energy, LNG. This is another one that's going to benefit. The small caps are going to benefit. REITs are going to benefit. A lot of that stuff are going to benefit. Unless I'm wrong and everything crashes together, so the big seven start coming down and Pepsi start coming down, all that stuff, it's possible that we could just have a crash in everything. But I think the opposite is going to happen. I think the rotation is going to happen from the big seven to 493 as interest rates start coming down. So 493 stocks, McDonald's, Pepsi, they're going to start bidding up. And if we do have some kind of a crash, according to the yield curve, it's likely going to be in mid 2025. And I'm seeing an amazing opportunity here. And I just have to say something. I'm up over 47% year to date. A lot of that stuff I took profits on. Not because I'm a trader, but I do short-term stuff and long-term stuff. My long-term investments, I never sold them. But I had some short-term stuff like LVMH. I bought it at the beginning of the year. I made 29% in 2 months. I took profits on it. I shared another one I did before, which was GFL. I made on it 14%, I believe, in 2 weeks or 2.5 weeks. I sold this one too. So that's what I'm doing with my money. Most of my money is now going into stocks like Pepsi, like dividend stocks, REITs, LNG, many different stocks. They're going to benefit amazingly well from lower interest rates and from the rotation. And investors are still blinded by this opportunity because all they can focus on is the AI and the big seven. But normally the outperformers become underperformers. The underperformers become outperformers. And this is what happens. And if you buy the underperformer, it's likely going to be the outperformer next year. And the outperformer is likely going to be the underperformer. That's what I noticed in my years of investing. But I'm still, playing with gains. So I'm not like down 5% and I'm trying to catch up. So if I'm wrong, I'm not going to be dead. And I don't believe Pepsi is going to go down as much as Nvidia could go down if we have a market crash or something else. So I'm positioned very well. That's how I'm positioned. I like what I'm doing. You can call me a trader if you want. I don't care. But that's what I'm doing in the market. Thank you again for watching me. I hope you enjoyed this video. Not financial advice, of course. If you did, please press the like button and maybe consider subscribing. And I'll talk to you in another video.